So great to be here. It's nice to be in a room where you can say an OECD report that I'm sure you've all read, and that's probably true. And I'm really excited about the panel that we have here. So I'll introduce them to you quickly, and then we'll jump right in. And please, along the way, be thinking of questions that you might have, because we'll have a lot of time for audience participation at the end. Starting to my left, Mike Mandel is the Chief Economic Strategist for PPI. Beth Ann Bavino is the U.S. Chief Economist for Standard & Poor's. Robert Quinn is the Senior Vice President for Federal Regulation at AT&T, a little company you might have heard of. And Jennifer Weber, who has the longest title of anyone here by far, is the Executive Vice President for External Affairs and Strategic Policy at Duke Energy. So thank you all for joining us, and let's get started. And Mike, maybe you can start us off. Tell us, you've been doing these reports now for several years. Tell us what we've learned about productivity and investment in America from your research.
Absolutely. So as Will mentioned, this is our fourth report. We started in 2012. What Will doesn't know is that when we have 5 of them, we're going to put them out as a special limited edition, okay, with a gold cover and everything. So please get your orders in now. At the point when we started this, we observed that the U.S. was having an investment drought. This was not a term that anybody was using at that point. At that point, people were thinking about a consumption shortfall. But we observed actually that there was a bigger problem on the investment side than on the consumption side, and it's only gotten worse since then. What we do in this report is really two-pronged. One is, well, really three. One is we document the investment shortfall, and we see that it's not simply the last couple of years, that on a lot of different measures, business investment is actually weaker compared to long-term growth than any other component of GDP. Second is, as we did when we started this, we wanted to say, yes, some companies are actually fighting the investment drought, are actually investing in the U.S. Now, this is a process to do this calculation that requires us to do some estimates, because companies are not actually forced to report domestic capital expenditures in their financial documents. So we do our own estimates based on public data. We do not ask the companies for any extra information. So they may or may not agree with us, but they don't even ever tell us, because they can't because of the regulations. So these are our estimates. And then based on, in part, the companies that we've identified as being investment heroes, we then can draw some conclusions about what's happening in the economy and what policies we should follow to boost investment. So first, I'm sure all of you have seen this report, but let me just read down the top 10 of the investment heroes for this year. It's AT&T, Verizon, ExxonMobil, Google, Chevron, Walmart, ConocoPhillips, Comcast, Intel, and Exelon, followed by, in the first column, Occidental Petroleum, Energy Transfer Equity, and Duke Energy at 13. These are companies that are investing in the U.S. Now, what's remarkable about our list is that you see that the 3 sectors that are leading, that account for the biggest chunk of investment, is the broadband/telecom/cable sector, the energy production sector, and the tech sector. These are all 3 of what you would consider to be the most innovative sectors in the economy. The energy production, of course, has been sort of stimulated by the shale oil revolution. The other 2 sectors are obvious. And I think what we're seeing in the economy at this point is that it's not simply investment that's the issue. It's also the nature of innovation. Because what we see is that in areas where you have a lot of innovation, you create a lot of opportunities for investment. Where you get investment, you actually get job growth. When you have investment, you get job growth and you get wage growth, which is what we're missing from the rest of the economy. So partly, and I would actually encourage you to sort of read past the initial tables in the report, we talk about policy measures that can be used to stimulate what we call inclusive innovation. By inclusive innovation, we mean innovation that's spread across the entire economy, that benefits not just one or two sectors, but everyone. And this is going to be a theme of ours going forward, the need for inclusive innovation. I should just sort of finish by saying if anybody's interested in how we calculate these numbers, there's a methodology section at the end of the piece. We have basically followed the same methodology since we started this, and I hope that you find this report a stimulating read.
Thanks, Mike. So, with that, Mabino, let's dive into the. Let's maybe pull back before we dive in.
Let's dive in.
Tell us about the state. Yes, exactly. Tell us about the state of the U.S. economy right now. What we see, what's going on with growth, and where we see it's going, and how investment and productivity help us understand the fact that we are 6 years clear of the Great Recession and still yet to experience the type of banner growth that has been characteristic of past recoveries.
Sure. So Jim, let's see. On the U.S. economy, what we just put out something, and I could hold it up right now, but I can actually. It's right here. I got it here somewhere. Hold on.
Hold up a piece of paper. No one will know.
No one will know. Okay. Anyway, yeah. Anyway, I got one. And actually, we can obviously get it. Here it is. You can do a close-up if you want. No. Anyway, we can get it out to you. But we did just do a report on that. And as far as the U.S. economy is going, it does look a little bit better. Obviously the question is, are we ever going to see that 3% growth, even higher, that for that matter? To give you a sense of why we keep waiting for this so-called holy grail, the 3% or plus, is that if you look historically at the United States, going back, say, even, I guess go back about 50 years, the year after a recession ends, we would see historically on average about 5% growth. We saw half that. In fact, it's being taped, but what the heck? I used to want to call my economic forecast half-fast recovery, which I thought was really funny and still holds, it seems. I wasn't really allowed to, because if you say it 3 times fast, you'll know why. But so we changed it to basically half-speed recovery, which is indeed what we have been going so far. If you take it out even 5 years, if you just look at the growth, average growth 5 years out, annual average growth is about 2.25. Again, it's half what you'd normally see. You'd normally see about 4.5 growth going back 50 years for a 5-year period after a recession ends. Now, there's a lot of reasons why that is. Obviously, we went through one of the worst financial crises since the Great Depression, and what we see there, generally what happens is you see deleveraging. You see people basically coming back, cleaning up, I'd say basically stabilizing their financial homes, both businesses and households, and now, of course, the government, stabilizing their financial homes so they save more and spend less. That means that you'd actually see very slow growth, of course. But the question is now we're starting to see households spending a bit more, but businesses seem to be holding back. They're kind of looking for that third leg. The million-dollar question is, when are they going to invest more? When are they going to commit to the U.S. economy? In our forecast for 2015 and 2016, we at least have it going higher. We have 2.5 for 2015. Second quarter GDP growth reading was really nice. We do expect to see some pullback, but holding up relatively well. 2016, a little bit higher than that, but again, still never getting over that 3% mark. One positive piece of news is that while we are waiting for businesses to really step up to the plate and start to really invest in in the U.S. economy, they are starting to hire more. We are seeing at least right now, I guess, 12-month average, monthly average is about, I think it's a little under 250,000 jobs gains per month. And we are starting to see some breadth in that, not just low-paying jobs. And we are also seeing, well, again, very, very minuscule, but we are starting to see wages pick up slightly. Indeed, some of it we could call, even at the low end, low-paying jobs, we call it the Walmart effect. You're starting to see some activity there in terms of investment. But I guess the point why we, like many other economists, kept expecting businesses to start to commit to the U.S. economy, start to spend more, invest, and as Michael had pointed out, when are we going to see that innovation? We haven't seen it yet. We thought after 2013, when the federal government, at that time anyway, kind of reached some kind of agreement, and we did have the shutdown, but we did have ultimately the Ryan Murray Act. We saw a shutdown deferred. We saw, of course, the debt ceiling crisis also pushed out a bit further. So we thought that this would actually clear, in a sense, kind of clear the outlook for businesses to be able to say that, you know, they have a roadmap in order to invest in their businesses and go further. We didn't see that. So what were the reasons if it wasn't Capitol Hill at that point? Couple of reasons that we were looking at that it could explain. Well, one argument could be, and again, this is something that we can go into, we can look at too, and maybe actually raise it to the audience, is that, is there a kind of a question of maybe actually executive compensation is basically kind of framing the outlook for public companies to be more short-term rather than long-term? That could be something that's holding businesses back in terms of investing on the long term. A couple of things is still no clarity in terms of aggregate demand. They don't feel confident that consumers are going to spend, and that's holding them back. While we have seen until, I guess, the last few weeks, we did see some calmness on Capitol Hill, but even assuming that there was calmness going forward, assuming nothing's happening in terms of the most recent talks about a shutdown, assuming that nothing even happens there, you're not necessarily seeing bills getting passed. And if bills aren't getting passed, then that's also something that actually encourages innovation among businesses. It's sort of something that opens up the platform. Another thing, R&D. Support for R&D is something that might also be kind of curtailed, and that also means that might actually slow down in business investment. And then finally, maybe tighter regulation. I know we're facing it, and many other businesses are. That might also hold back on terms of businesses' interest to go further in terms of investing in their companies. Some ideas that we have out, we keep waiting for the businesses to kick out in full gear, but we haven't seen it yet.
Well, thanks for that. That's a great spin through. So, but now let's actually dive in, and let's just put Robert on the spot. Can you just speak for the entire business community here? And I can't. I've been writing stories about this for years. I can't believe I've never thought of this before. What's holding you back? Just tell us. It's okay.
We're one of the heroes. I mean. I think the reports that Michael has done, I think we've been in just about every one of them so far. And we've had an enormous amount of investment that we've done in our broadband infrastructure. And a lot of that is driven by consumers' demand. They want more broadband. They want faster broadband. We made the move from 3G services to 4G services on the mobile platform. Which drove that was an enormous amount of investment that we had to do to make that leap forward. But it was something that consumers wanted to see as a result of wanting to be able to do the things on their mobile devices that they could do on their home computers. You know, it's odd to think about it, but the iPhone came out 8 years ago. That was the first real smartphone. So you kind of look back, we had a 2G infrastructure when we introduced that iPhone, where we've gone to from 2G to 3G to 4G to LTE. I mean, so that's 3 or 4 different generations of technology that our industry has really led the charge for to invest in order to make the mobile broadband experience a good experience for all concerned. But that investment occurred at a time, and I'll get back to what we were just talking about, which is the tighter regulation that exists. That investment all happened at a time when broadband, whether it was on the mobile platform or whether it was on the wireline platform, was in a space that the regulators in this country in 2000 had kind of declared off limits for regulation. They took it out of Title II regulation, which is the traditional tool that regulators and policymakers in this country have used to regulate rates. And we had, as a result of that, I think we had an explosion in investment, first on the wireline side, then on the wireless side, continuing on the wireline side. We just did a deal with DirecTV, and we're going to build fiber to the home, which we're using to deliver 1 gigabit services to homes in a number of different communities. We're going to build that out to about 12.5 million households. Verizon did an enormous amount of investment in their FiOS infrastructure, despite getting pretty heavily criticized by the street for making that investment. And so I think we've kind of led the charge, but the warning clouds on the horizon would suggest that the FCC's action last year to go back to a Title II form of regulation I think that creates a lot of uncertainty. I know that the talking points today are we're not doing this for rate regulation, but there's an enormous number of storm clouds on the horizon. They start talking about, you get people from the commission out talking about usage allowances. Oh, we have to look at the usage allowances that are out there. We had a lot of conversations with the commission about usage allowances during the DirecTV merger. And it's all a precursor to them coming in and regulating rates. I always felt that the net neutrality battle was designed to make sure that, that the broadband providers didn't make any recovery, if you will, from the edge providers. Title II is all about making sure that that recovery can't happen on the consumer side either. They go hand in hand with one another. And I think as a result of that, I think in the 2015 numbers that you've seen a lot of the broadband providers start to back away and back off a little bit of their investment. I know our investment numbers went from 21 to 18, 21.4, I think, to 18. I think were the CapEx numbers 2015 to 2014. We adjusted upwards after the DirecTV deal to accommodate for the $3 billion in DirecTV CapEx that they had already committed to. So we edged up, but net we were, that's a reduction based on what we both spent in 2014. And I think you're going to continue to see that as these kind of regulatory clouds hang on the horizon in our industry. And our industry, I don't believe, has really been impacted the way that the rest of the economy has. I think through the recession, the telecommunications and broadband providers continued to invest in America. But I think what you're starting to see is you're kind of starting to see the edges of a little bit of wariness, a little bit of uncertainty as to what this is going to mean in terms of rates, and are we going to go back to full-scale rate regulation? And I think you're starting to see a little more caution creep into the way that we're approaching that environment.
Well, there's an interesting contrast here. Jennifer, can you tell us about, I mean, you are in an incredibly highly regulated sector and yet are investing a lot. So what is the relationship between your investments and in particular the environmental regulations we've seen come online?
Sure. Well, there's a very direct relationship between environmental regulations and the way that we invest. But I would say that there are really three things driving how we think about investments as a regulated utility. One is customer sentiment and expectations drive in large part the way in which we think about investing. So we're continually looking for different ways, new ways. I think the telecom industry actually is an industry that came before us in that, where the advancement of technology is a second one. So as technologies have advanced, it has impacted consumer expectations, and it's incumbent upon us to make investments in a way that we're looking to serve our customers in new and innovative ways. And then the third one would be public policy and regulations. Certainly put pressure on our company to make investments to become more environmentally clean. And so as we look at these three areas of focus that really drive our investment profile over the long term, we need to balance these things in a way that puts us in a position to continue to fulfill our commitment to our customers around providing reliable, affordable, and increasingly clean energy into their homes and into their businesses. And so that's a balancing act that we have to play. The EPA has been very active in driving how this roadmap looks for us over the next several years, how the roadmap looks for our states over the next several years. And so we have one now, and now it's incumbent upon us to work, and I'm referring to the Clean Power Plan, which is by far one of the most complex, comprehensive, controversial environmental rules that the EPA has published. It's incumbent upon us to work in a really constructive way with each of our states to say, what does a compliance plan look like? And one thing that's really important, because it's directly related to attracting growth in the states that we serve, is that we comply with these things in a way, we respond to customers in a way, we implement new technologies in a way that we continue to be highly sensitive to keeping our rates as low as possible. Because the cost of electricity is one of the two top expenses for many businesses. And so when companies are looking to grow, when they're looking to expand, when BMW is looking to build a plant, they actually look, what does electricity cost? And we're actually really proud because we've been intentional about making sure that we're keeping our rates below the national average. So we are putting our states, and we're across 6 states in the country, in a position to compete for growth. So that's what I would say at a high level. We can dive into any of those in more detail, all big topics.
I think that would be great in just a minute. I bet you all didn't realize you were just coming to a regulation panel, but I do want to stick with regulation for one more question for Mike, which is that you document this sort of bifurcation among sectors in investment in innovation, and you find that innovation is chilled in a couple of sectors where you think regulations are going. Can you tell us about that?
Absolutely. So the report actually identifies. We've done a lot of work on regulation, the impact of regulation and innovation and investment. Including proposing a regulatory improvement commission. This paper, we sort of identified 2 sectors that are potentially affected by regulation in terms of investment. One, of course, is the effect of Title II on the broadband, on investment in the broadband telecom industry. And in the first half of 2015, investment of the 4 companies that are on our list is down 11% over the previous half year. So 11% is significant. It's hard to know exactly what that's from, but it's suggestive. The other industry that shows up as really interesting is healthcare. If you look at the list of 25 companies, one of the surprising things that you don't find on the top 25 is healthcare companies. And that fits actually the macroeconomic data, which shows that investment in the healthcare industry is low relative to the rest of the economy, and growth per worker in investment is lagging the rest of the economy. Our view on this is that cost containment regulation has moved in a perverse way so as to hold down investment in healthcare, hold down productivity growth, and actually raise long-term costs. And I think that we have to understand that some of our investment drought is the result of not well-targeted policy. And of course, healthcare is an enormous industry, and so it's actually responsible for a lot of the investment slowdown. I also want to say, though, we could go beyond regulation to talk about areas such as tax policy, budget policy, and so forth. The U.S. tax rate on corporations remains far above most other industrialized countries, and some of the changes going on in the international tax sphere, which I will not subject you to, but let's call it the BEPS project. You may actually hear about it next week, coming out of the OECD, where the final reports will be released, will have the effect of actually accentuating the effect of these tax rates. And I think that we in the U.S. don't actually understand how much of our problem is self-created. So that part of it is narrow innovation. We need to move towards more inclusive innovation. And part of it is government policies that perversely have the effect of holding down investment by companies.
And what, I don't think Jason's here yet, but if he was, what percentage of those policies would you say have been implemented, of the innovation hindering ones, have been implemented since the crisis?
Well, let's actually start with the weakness in investment in healthcare. Okay, that's a long-term problem that predates the Obama administration, predates the changes in economic policy there. We in this country have had a long-term history of perverse cost containment processes that sort of lead healthcare companies to hire more workers and invest less in productivity enhancing equipment and so forth. And so I think that what we're dealing with here in this country is the effect of long-term policy choices that we've made. There are things that have gone on more recently, such as the Title II regulation. But we've documented this, that the regulatory intensity increased under the Bush administration as much as it increased under the Obama administration. This is something that you can actually, one of the ways you look at this is you look at the number of regulatory workers in the federal government, and what you see is that it actually went down, or down as a share of the private sector under Clinton, okay, and then kind of has risen since then. So we've had in the US under both Republican and Democratic administration a shift towards increased regulatory intensity, which we think is actually problematic for business investment, but actually one of the reasons why we've had slow wage growth and slow job growth.
Okay, so let's jump to job growth and wage growth for a second. And I'm fascinated by your argument, Patan, about CEO compensation, which is something that has been raised repeatedly on one side of the campaign trail right now as a possible explanation, and short-termism as possible explanations for why we are seeing so much cash still sitting on the sidelines for companies. Can you elaborate on that a little bit?
Well, from what I understand, and I'm not an accountant. If there's an accountant, raise your hand. We'll ask you. No, no, there isn't. From what I understand, I mean, this is something that we've been kind of looking into, kind of getting a sense of it. I guess the broad story is that if you, I believe it's a statute, IRS. I think it's 262, but I'm not sure, so you want to check that, which sort of opens up in terms of executive compensation to, say, stock options. That kind of gives the incentives, and increased, for executive focused on spending more time on the stock market, aware that this is actually affecting their bottom line, their own personal bottom line, basically, say, next week or next month or even 2 years from now. The incentive, whether it's just human nature, to think about it, it's that, well, if I make this investment that is long term, that I see maybe could potentially be a good thing for my company going long term, but short term, will I stay? Am I going to be there for the overall period, or am I leaving in 3 or 4 years? Well, short-term incentive, just human nature, would be say, well, maybe we'll hold off on doing that investment, because what matters is, the focus on what's happening to the stock market and to their stock in particular. Now, there's been some studies done on this. It's not very clear. It's still debatable, but I think it's something that, that should be considered and looked at when we talk about this question of innovation. Another thing that, another thing that Michael brought up about tax changes. What's interesting is that both sides of Congress are looking for tax reform, but at the same time, I think that what Michael had said so clearly is that some of this is so embedded. Basically executive compensation is something that's happened. This is something that probably goes back before the financial crises. Something that's already embedded, but it's already having a mechanism on incentives. Tax reform. How does that how is the response for businesses? Think about the mergers that are happening in order to basically benefit on taxes abroad rather than staying in the U.S. because, as Michael pointed out, taxes are very high. It makes perfect sense. It makes perfect sense for a company to do that, at least in the short term, but it's hurting our U.S. productivity and certainly could also hurt our innovation because it's sending the business outside, or sending a lot of that product outside. Another thing that's long term, the question of immigration reform. Another thing that indeed we educate a lot of these people, but then we send them abroad. Another issue for productivity going forward. We don't get to keep them. To give you a sense on immigration reform, there is a in Silicon Valley. There's a billboard that says H-1B visa problems, pivot to Canada because it's a lot easier. So anyway.
Yes, Greg, you appreciate the Canadian plug. I have a question for both of our business representatives here. When we think about the arguments that we have heard over the last several years, the explanations for why we haven't seen more investment broadly as a business community, one of the ones that came up for the first several years was there's all this uncertainty from Washington. We don't know what's going to happen. We don't know if the government's going to function, if we're going to hit a debt limit, if the borrowing costs are going to spike. How much is that a factor now, do you think, in your sectors for concerns about the government as a potential cause for holding back on investment?
Well, I mean, from the broadband provider's perspective, I think that there's, as I talked about before, I think there's growing uncertainty, but it's really related to, the creeping regulation coming back into our environment. The FCC acted last February in the area of enacting, declaring broadband services to be a Title II service. It's going to have impacts, I think it's going to have impacts well beyond the broadband provider sphere. Talk about the area of privacy. There hasn't been a privacy regulator that really has the power to enact rules on broadband internet companies' privacy issues, right? The Federal Trade Commission does regulate in that area, but they regulate in that area via consent decree, establishing kind of broad principles. There's not a whole rule framework. You look at the FCC when they wade into this area, they're going to wade into this area and enact rules. That's what their MO has been forever. And it's inconceivable that they're going to enact a bunch of rules that aren't going to creep into other parts of the internet industry, right? And it's going to creep out to the edge providers as well. And one of the things that I can tell you, we were in the Title II world, in the voice service world. A lot of people view control over the telecom world or the broadband providers world as their means to start controlling people who hang off of that community. And in this case, that's going to be all the internet companies. So I think that has been a huge factor. My CEO gets out and talks about the corporate tax rate also as another factor. I don't know that that's uncertainty. I think anyone who's watched Congress for the last several years, I think no legislation seems like almost a certainty. We need legislation in order to fix that issue. But Randall talks about that all the time, and that's one of the things that he talks about when we've made some investments in Mexico. And he talks about the regulatory environment in Mexico, and I think, even as our company, which has led the way in investment in the United States all through the recession and beyond, we're starting to look other places in the world to put our money, and Mexico is a big part of that. And so, when we talk about the CapEx dollars that we spent and how they went down, the thing that went up was investment in international markets, and that went up, and so you kind of can net that out from the domestic investment and say that number grew, shrank even more. So I think those are the two big issues I think that we see. But like I say, we don't know what the regulation's going to be, and I think that creates an enormous amount of uncertainty that didn't exist prior to the beginning of this year.
I would say very similar. My response will be, but I'm going to say it a slightly different way. I would say that when you allow market forces to work, they actually work. And so over the past decade, Duke Energy, we've seen market forces that have allowed us to invest in ways. I'm going to use this as an example. The Clean Power Plan addresses how companies or how states need to bring down their greenhouse gas emissions, right? And so we, over the past decade, because of natural gas prices coming down, the cost of renewables coming down, have been in a position to invest on our own in the absence of coherent energy policy, and over the past decade have actually reduced our carbon emissions by 22%, right? So we didn't really have a roadmap. We didn't have legislation that had been passed. We knew something was likely coming at some point in time in the future. But there were some market dynamics that made those investments attractive to the company, and it made sense for us to proceed with those. So I think that's one thing. But nonetheless, I do think that all things being equal, when you can get more clarity, it's better, because we are a very long-term, capital-intensive industry. And when you can have coherent policy or legislation that provide some framework that is not overreaching in any way, it's good for us in general. The second thing I would say is on tax policy, and our CEO says the same thing, bringing down the corporate tax rate is going to help tremendously. The other thing that would help, we're largely a domestic company. We invest significantly in the United States. We will continue to do so in the future. Our estimated CapEx for 2016 is close to $8 billion. So hopefully we'll be on the list again next year in terms of our domestic investments. But the other thing that would be very helpful is if there's an economically efficient way to bring, we do have we have businesses in Latin America and South America, but we don't have a consistent, economically efficient vehicle to bring foreign profits back into the United States and invest them domestically. So I think that would be another thing that would help encourage ramping up investments in the United States as well.
Although in the past when we've had repatriation holidays,
Yes.
they have not, the studies have shown, have not really led to big boosts or any boosts in investment, right?
Well, maybe as you look at it, but we did. I mean, we took advantage of that, and I mean, it put us in a position to, we're investing in the Atlantic Coast Pipeline. We're a 40% owner in that, so we're bringing into the Southeast a much needed source of natural gas. Since that's going to be an important fuel source to replace a lot of the coal retirements that have occurred and will continue to occur in the future. So, I mean, we actually took advantage of that and actually put it to work domestically. And so I think that that's a really good indication that if there was some consistent, sustained way to do that, you would propel and encourage further domestic investment.
It strikes me that both of you are telling some basically demand-driven stories here that are very much about innovation. That you are, the demand is for cheaper energy, and so you are finding, you're looking for new ways to get, and cleaner. There's a demand both from the government and from consumers to get cleaner energy, and so you're looking for ways to do that. The demand for faster, better broadband service, for faster ways to connect, that's a driver, and that, so how, to the extent that demand stays high, how much does that push you to keep investing in innovation regardless of what the environment looks like?
Well, I think like anything else, you gotta be able to make a return on the investment, right? So what the FCC has done with the net neutrality rule specifically is they've cut off a whole potential market which was designed to what kind of services can we basically sell to the edge providers? What kind of innovations can we make to make the relationship between the edge provider and the consumer a better relationship, better services? And so we have a ban on paid prioritization, and we have a whole bunch of language in the order that says, hey, if you do a deal with an edge provider, we're going to look at whether or not that's competitively neutral, and we're going to put that under a microscope. And oh, by the way, we would like you to bring those proposed services in, and we'll give you a non-binding advisory opinion. So you bring them to us, you tell us all about them, and we'll sit on it for a while, and then we'll give you an opinion as to whether or not we think you can do it. But the opinion's not binding because, it's going to be from the staff, and they're not the commissioners, and so that can't really be the case. And oh, by the way, we're going to make that all public. So who's doing that? No one's going to do that, right? And that's what I mean. So yeah, there's going to be demand for better services, but if you can't develop them and bring them to the market, and you have to go and expose them to the public, no one's going to innovate in that space.
So if you think about the introduction of the iPhone, when the iPhone came in, it came in with a tie to AT&T and the new data packages. It's an open question whether or not the iPhone would have been able to be introduced the same way under the current set of regulations. Okay, it might have been a much slower process. It might have, it would not have been the accelerated growth that we've seen. I think that we've seen pretty consistently that that increases in regulation tend to sort of focus the minds of businesses on the regulators, as opposed to the innovation. And if we think, as we do, that that a lot of the investment drought is a function of an innovation shortfall in much of the economy, then what we're doing is we're shooting ourselves in the foot.
So you're arguing that companies focus on influencing regulations or attempting to comply with regulations to the detriment of investing in the actual innovation
Well,
itself.
think about it this way, all right? Companies only have so many goals they can hold in their mind at the same time. Okay, I'm not a real big fan of the short-termism hypothesis, but I think what is clearly true historically is that the more that you regulate an industry, the more that they focus on regulators, and the less that they worry about innovation as a way to move forward. It's not a surprise that the innovation in the tech space happened in an area that was fundamentally not regulated from top down. It is also not a surprise that in the broadband mobile space the same is true, and that in industries like healthcare, which are highly regulated to the point where there's regulations on payments and so forth, that we've had not just weaker levels of investment, but weaker growth in investment than the rest of the economy. So let me get to your consumer demand point, though, for a second. Okay, demand. Where do you get demand? You get demand from two places. You get demand from if your income is rising. The other place you get demand is if there's new products and services out there. Because if there's new products and services, what happens is people want to buy them. They say we must have the next generation smartphone. We have to. It's a necessity. My kids need it to play games. Okay? Whatever the reason. All right, they need, or in the case of the energy industry, all of a sudden we've opened up all these new fields that were formerly not profitable to drill in, that have become profitable, or we think may become profitable in the future. We're willing to borrow a lot of money to invest to take these new opportunities. So in terms of creation of vast new reasons to invest, innovation is the biggest stimulus there. And I think that to the degree to which that we are running that a lot of our problems these days come out of that our innovation is limited to a couple of areas of the economy that are very important, but are not as widespread as they have been historically.
Okay, but is this a plausible, explanation for why this? Yes, Bethan. Let's bring this back to broad economics, and I hate to be the skeptic here. Actually, I don't. Why? Well, no, I do. I'm a reporter. Why would it be true that this recovery is so much slower if it's largely an investment slowdown story driven by increased regulation? When yes, there has been increased regulation, but not to the degree that would correspond exactly to the huge difference in historical growth versus what we've seen in this recovery.
Well, I mean, so why is this recovery so much different?
Well, no, you talked about a lot of that in the beginning, but I guess what I'm asking is it a complete story to say we have too much regulation, which is chilling innovation, which is the reason why we don't have the investment, which is a big reason why we're not seeing the sort of growth that we want?
Well, I think there's a number of reasons. Can we do a top 10? I mean, I mentioned, I sort of kind of went down the list. You've got the question that regulation is one factor. Basically kind of a cloudy regulatory environment keeps businesses from holding back. And it doesn't just necessarily have to be on the corporate side. We have two members of the corporate community, but also think about Dodd-Frank in terms of, we also need money. Corporations also need money. We have Dodd-Frank in place, and that means, and banks are holding back in terms of, or had been holding back throughout most of this recovery, keeping reserves up and basically holding back in terms of lending with tighter restrictions may be necessary, most likely very necessary given what we went through the financial crises. But at any time, history always shows is that the pendulum never stops in the middle. It swings all the way over here one time, very, 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 basically lax, possibly very lax regulatory environment. Then it swung to the other side. Where's the happy middle? We're not there. That could be one fact. Regulatory in terms of corporate factors, that could be one place. But let's not forget the lending side of it. I mentioned other factors, whether is it that you're not seeing basically the kick in terms of aggregate demand really playing, kind of going into place? We did come from the worst financial crises since we're in one of the worst since World War II. We've seen what happens when that happens. When you have a financial crisis of what we went through, well, what do we see? Well, we basically deleverage. We've all. Okay, I bought the book, but I didn't quite finish it. This time it's different, but I got the cliff notes anyway. And so when you get a sense, it's basically when you go through a crisis of that extent, people save more, they deleverage. We saw that with households. I believe businesses also were very focused on basically cleaning up their balance sheets. You see a lot of businesses sitting on a lot of cash. Then you go to the other question is, when will they commit? When will they commit to investment? I think the roadmap is still rather cloudy for them. I did want to add one more point, and it's probably should have been the first thing I talked about. There's a whole question about the productivity, the number. You have a debate among economists of, is the productivity number actually correct? There's people who argue that it's mismeasurement, that it's not really capturing the innovation. Think about when you have an iPhone, and all the apps that we have, we get a lot of productivity out of those apps, but is it captured in the GDP data so that it actually doesn't feed into productivity? Hard to say. Probably part of the equation. Then you have the second part. Let's say the productivity number is correct. Then you have two things. Is it cyclical? Is it really just tied to what happened in the financial crisis and very weak recovery that's keeping low productivity? That could be part of it as well. But then there's the other question, the other issue, is it structural? I mean, again, I don't have all the answers on this. Actually, probably don't have any of them. I don't know. But the question is it structural? What Michael had talked about in terms of the innovation question. It's not something that just started in this financial crisis, so the cyclical component isn't really there. It goes back further. What are the structural questions at play? Now, to take that to one step further, since I always love to talk about the Fed, now how does this bring in the Fed in this measurement? We've been talking about the slowdown in the economy, but think about how this plays in. So if you have a structural problem, a question of productivity, but we will have very low productivity going forward, well, what that means is that, well, we're not getting the whole question of basically unit labor costs. We're not getting the number of widgets that we get out of that person that we've hired doesn't really increase because productivity actually slows, you could say, because productivity is so slow. So that means businesses will need to hire more people just in order to keep up with the amount of widgets that they want to create, not to mention expanding as well. So if that's the case, then they're going to have to hire more people just to keep up with the number of widgets or products that they want to create in a low productivity environment. Well, eventually, supply and demand, that means that wages will eventually climb very higher. Now that, again, we're going out further.
But we're not seeing that. I mean,
structural question. I know, this is why it's so shocking. I mean, it's so hard to imagine. But then you go out further. If this is the case, if we do have a structural issue in terms of productivity, then that means that wages will climb higher and the Fed will need to move and basically raise rates. This is something that's long-term. It might, again, it really is the question of what is the measurement of productivity? Is it cyclical? Is it structural? Or is it just not really measuring at all? But something to think about when you take it further.
I'm glad you brought up wages, and I want to toss out a question to the whole group and anyone who wants to take it to start. We've been talking about all these concepts from a business or a macro standpoint, but when we talk about productivity and investment, what does that mean for the average American worker and the experience that they have had both of declining and now flatlining median income in this recovery, and over the last 25 years, basically median incomes that are the same as what they were in 1989. Where do productivity and investment fit into that picture, and why should the workers at your companies care about them?
Well, I mean, I can start on that. I think that over the past several years, and we actually saw an impact to our business that we had not seen in at least in the history of many of the people's careers at Duke. As a result of the recession, we did see the usage of electricity go down residentially, and it was measurable. And as a result of that, so many companies, ours included, looked at how we needed to really tighten our belts, and we needed to get more out of every employee we had. At the same time, what we're seeing is because of the advancement in technologies, there's a demand for new skill sets out there. And our example of that would be smart grid. So we have, a large technical workforce, and we have a huge need, as do many contractors, as do many of our peer utilities, to hire talented, skilled craft workers who understand that the grid now is a two-way vehicle for communication and not just a one-way source of distribution of electricity into the homes and businesses of our customers. And so that's actually putting pressure on wages now. So we're beginning to see that dynamic. So there was a productivity thing, and there still is, that we've had to respond to as it relates to responding to a lot of cost pressures that have been driven by a decrease in demand actually for our product. And we, at the same time, need new and different skills. I would say one thing that becomes really important in this is every company, every university, every state, every community doing their role in workforce development, because I think that's another really important consideration in attracting growth to our communities, is that you see, in fact, next week I have a dinner with a potential prospect who's looking at moving their headquarters to North Carolina, and all of their questions are around the supply of a ready workforce to meet their needs from a workforce standpoint. And so I think all of those things, now I'm not an economist, so you can pull all this together in a way, but I think all of those things are really important factors that we as companies need to be mindful of figuring out and getting creative in terms of how we invest, how do we develop the talent, and how are we ready to meet the needs, to continue to meet the needs and new demands of our customers.
Yeah, I mean, we have a similar story, and I'll also say I'm not an economist either, but I mean, for answering this question, I think it's, yeah.
Who you're asking.
I mean, we're going through the same thing, and we've actually seen the decline. If you think about our business, we were a circuit switched voice telephone company basically up until about 20 years ago, but broadband really didn't take off in this country until probably about 15 years ago, where we really started to go away from dial-up internet and into the broadband world. And when you look, I mean, I've been with AT&T for a long time. I've been there 35 years. I started as a 411 operator. We don't have 411 operators anymore. I mean, that's the reality. I mean, I could go through all this. We talked about, I was there when we first sold cell phones at a phone center store back in 1981, and they cost about $5,000. We put a suitcase in your trunk, and then we drilled a hole somewhere in your car for the antenna, which is always good, because somebody buys a car, the first thing they want, so they want to bring it to somebody like me so that we could drill a hole in their car, right? But I mean, that's you think about how fundamentally it's changed. We bought Bell South in 2006. We bought it on the last day of 2006. When we bought Bell South, we had, between the AT&T footprint and the Bell South footprint, I think we had 38 million residential access lines in service. Today, we have about 8 million. So think about that. That's 8 years ago, right? So you think about the skill sets of the workers and how we have to change the workers. And it's forced us to do a number of different things. I mean, because the skill set to do circuit switching is much different than programming stuff to be able to provide broadband service, to do the electronics necessary to do that. So we've had to create a smart workforce program that we spend an enormous amount of time on. Our HR people are always talking about the education necessary to change the skill sets of the workforce that we have today, because you've got a huge workforce. We have more than 250,000 employees, so we've got to put them to uses that we need. You can't just walk away from the investment you've made. You've got to keep them up to speed. But I think as a corporation, it's also made us focus on education in general. And Randall started the Aspire program, and we've done partnerships with Georgia Tech, and we're working to help lower the dropout rate in this country and getting people, getting the skill sets of the citizens of this country to get them ready to be able to be useful cogs in the machine, useful assets, partners, so that we can continue to provide services on a going forward basis. So I think it manifests itself not only in trying to change the investment that you've already made in your people and trying to get them retooled for the new world, but it also says we got to look out at the talent pool out there and make sure that the kids coming out of high school today are prepared to be able to get the education they need to be part of the workforce in the coming years. And as a company, we've just really pivoted towards the education issues in this country. And Randall's very, very committed to it, and we spent a lot of money to do that, all because of this idea that we've got to retool the workforce.
Can I just add to that? Because I do think companies play such an important role in this. Similar, we've got to focus on something called K to career, because we've recognized that it starts very early. If you're going to have somebody prepared to be productive and ready with skill sets, employable skill sets, it starts at a very young age. So we used to be focused on STEM, but you can't really get to STEM until you address literacy. And so when you look at the continuum of the educational cycle in the U.S. from a very early age to the point where they're either going to a community college or a four-year degree program, how do we get them as ready as possible? And we're investing significant amount of money in making sure that we're doing our part, not just because of the workforce we need, but the workforce a lot of companies need to make our states attractive to invest in. And so I just think that the private sector's engagement on this is really important.
My press guy, by the way, is over there cringing that I used the term cog in the machine, so just forget it.
Is he giving you hand? Is he giving you hand signals?
So I think what the investment in human capital here is extremely important. It's one thing that was not covered in our report is human capital investment. I do have to say that the relationship between investment, productivity, and wages is almost a very direct one, which is that the more capital that workers have to work with, the more productive they are. And the more productive they are, on average, the higher the wages are going to be. Okay, and what we've seen here, I'm going to say, for those of you who have the report in front of you, if you open up to page 2, figure 1, okay, what you will see is that the growth rate of capital is, a 10-year growth rate, is at its post-war low. Post-war low. What this means is that, workers in this country, okay, have less capital to sort of work with than they have had before. That makes them less productive on average, and it makes them less than on average, no matter what else is happening, the wages are going to be lower. I will have to say this differs by industry. In what we call the tech info sector, which includes both the broadband providers, telecom, cable, and the tech sector, okay, the growth rate of capital per worker has skyrocketed compared to the rest of the economy. So, and in those sectors, wages are going up. In other sectors, you have much slower growth of productivity, of capital per worker, investment per worker, and you see much slower wage growth. So these things are not a one-to-one correspondence on a company by company on a year-by-year basis, but on average, the weakness in investment is in fact tied to the weak wage growth.
Although we do hear a lot, again, particularly on the campaign trail right now, about that breakdown in historical relationships.
You don't have a breakdown. That part of what's going on at this point is that people couldn't figure out what was going on in productivity growth because of the cyclical nature. Right now, at this point, pretty much everybody accepts that productivity growth has slowed much more than they expected, and you're seeing a pivot to sort of talking about investment, innovation, and productivity growth as being the main driving force for wage growth, and not the split. Because, frankly, what our problem is right now is slow growth, and especially slow productivity growth, and that's your first order reason why wage growth is slow.
Okay, so
I just wanted to add, one of the, because the confusion between mentioning basically the question of if you're seeing businesses not getting the bang for the buck out of their employees because basically the productivity is slow, so they need to have more employees, you could see nominal wages going up, but in terms of real terms, you would see wages still being low. It's the inflation part I was trying to focus on.
So so now let's turn to the solutions portion of this. What if productivity is a driving problem in the country right now? How do we get it going faster? Anybody who wants to take that first?
Well, I mean, a lot of them had been mentioned already. I do agree that. Well, okay. So if you just look at terms of infrastructure. Basically, education is also infrastructure, social infrastructure, you could say. So there you would take it in terms of infrastructure, just in terms of roads, bridges, telecommunications, something that could be opened up much more readily and improved. We have, I think, a D+ on average in terms of infrastructure, according to, which is the American Society of Civil Engineers, I think. So we're certainly far behind on that. And if indeed we do have better roads and highways, or better anything in terms of infrastructure, it makes products go more smoothly. Helps with development, helps with productivity, because things can get there sooner. You'd expect to see an improvement there. Also, in terms of, I'm very glad my colleagues to my left, I guess, had mentioned in terms of basically investing in human capital. I do see that as something that, when we talk about structural questions of productivity, one of the structural issues could be that, yes, we have technology improving, but do we have the workforce that actually can man the machines, I guess you could say. And if we don't, then of course productivity will slow no matter what kind of computer we have at the desk. So I do applaud that both of them actually investing in the community and investing in their own workforce in terms of basically keep them up to speed with the changes in technology. I guess I'll stop there. I have a few more, but pass it to others.
I'd ask maybe a little more direct version of it to the two of you. What could the government do right now, tomorrow, that would boost investment in your sectors in the short and long term?
But you can't guess.
I was going to say this is like Wheel of Fortune. I'm just going to go ahead and give you the E about regulation, but go ahead.
Yeah, I mean, I think that I think our industry has been a model of how to keep investing and how to move forward in productivity and how the government should want us behaving through the recession and beyond. We're taking a step backwards, and it seems like we got at least one part of the economy that's actually working very well. And now we're going to try and throw that cloud of regulation into it. I think it's a huge mistake from a policy perspective, and I think it's going to cost us. And the government ought to remove that. What we ought to do is we ought to go back, to preserve net neutrality without the heavy-handed shadow of Title II kind of common carriage-like regulation. That is a policy that this administration embarked on last year. I think they ought to reverse field on that, and I think we ought to go back to the preserving an open internet and go back to the model where an enormous amount of investment gets made and productivity gains happen. And from our perspective, that's what we would like to see.
I would say, well, we've talked about taxes in two regards, and I would say that's something that we would love to see be addressed at some point in time. And I think there are a number of different ways that the government can just make it economically attractive to invest in our country, and we've touched upon a number of those. I would say the other thing is, I don't think it should be a surprise that we are a critical infrastructure company. We are hugely capital intensive. We deploy billions of dollars of capital a year, and we're highly regulated, right? And so I think thinking about ways, and I don't know what this looks like as it relates to the government, but thinking about ways where it's attractive for us to invest in research and development and the advancement of innovation is important. That's an important part of our business. We do it. It's a challenging thing for us because we are a business where we look at these investments. You go make the investments and you go get cost recovery for those investments, right? So when you think about the proposition of research and development and investing in ways in which we can innovate and continue to add value to the lives of our customers and empowering their homes, empowering their businesses, you think about things like battery storage technology. That's a real game changer in our industry. I think it's going to actually allow for then and open up more, even more so than the fact that the cost of solar has come down. If there are advancements in battery storage technology, that is a game changer. And we have these pilots going on. We actually do make investments there, but it's difficult in a regulated environment to do that. And so I think if the government could figure out a way where the private sector and these huge companies that deploy a lot of capital every year, that it can be attractive to accelerate their investment in advancing technologies and R&D around that, I think that would be a pretty compelling proposition.
I'm very glad, Jennifer, that you brought that up. I think if you think about regulated environments where there's cost recovery, because you have to, you actually take away a lot of the incentive to innovate on both sides. You can't get the gains, but the government's also protecting you from losses. And so you have to imagine that you want a world in which people can get big wins from innovation, because innovation is kind of what pushes the economy forward, which pushes wages forward, which creates investment opportunities and creates jobs. The more that we move towards regulation, and let me actually tell you why this is a 10-year phenomenon or a 15-year, it really starts with 9/11. Okay, that turns out to be the break in the, I was, I don't know, people don't know, I was the chief economist at Business Week for many years, and I was actually just sorting through old papers and I saw the covers from 9/11. At that point, what happened is you had a big increase in regulation across the entire economy in the transportation sector. If you think about TSA, how much time is wasted there? Okay, if you actually added it up and you thought about that, what the drag on the economy is, you actually kind of get a sense that there's been a progressive shift since then that was not present in the 1990s under Bill Clinton towards an increasingly regulated economy. And the more regulation you have, the less incentive that it takes away for innovation. Now, so I wouldn't say that regulation is the be-all, end-all, but I would say that we're living in a world where more innovation across a wider range of areas would be a good thing. Good thing for everybody, good thing for investment, good thing for productivity, good thing for workers, good thing for the creation of jobs. And anything that we could do towards that area, and that towards what we call inclusive innovation, is going to be beneficial. And it's not just one policy, but a whole set of policies.
All right. This has been a great discussion, but I would like to throw it open to the audience. Any questions you all might have about investment or regulation or what 411 was, any of that, we're happy to take them. So, yeah, we'll start right here.
Thank you. I'm sorry. Sharon Bovat, Voice of a Moderate. I have a question about I think it's 2009, 2010 stimulus. There was a lot of money put in, and I heard some outrageous numbers, like it was $2 million per job created. We probably would have created more jobs had we just given the people the $2 million, because a lot of the jobs were temporary, and they went away. And even though the climate change is real and green energy is important, now we're kind of going back to what you were talking about, the gas. So I have a question. Is there a free market solution, or do you recommend that the government be controlling this all-inclusive program? Because people want to see jobs created. They want to see a faster comeback from this recession. And it seems like there just has to be a better management of the spending of the tax dollars.
Well, I just need to sort of say the PPI mantra. We are pro-growth, pro-market, pro-worker. And we see these things as all being consistent with each other. We believe that regulation is important, but you need to have smarter regulation. I'm not going to speak to the stimulus because that'll get us involved in so much economics that we'll never get out of here. But I think there's a way to sort of accomplish the policies to accomplish both things, to both boost innovation, boost growth in a way that is beneficial for everybody.
Okay, we'll just keep whipping through the questions because there's a lot. We'll go down here and then we'll start working our way around the room.
Thanks. I'm I'm Bill Galston from Brookings. A couple of months ago, in a publication that I have some association with, Alan Blinder wrote a piece called "The Mystery of Declining Productivity Growth," and he uses exactly the same figure that you do, 1.3% over the past 10 years, but he calculates that declining investment explains only 25% of that shift. Do you agree or disagree with him?
And the other part of it is explained by falling multi-factor productivity growth. Okay? And the answer is we would agree with that. So that in fact, so that if you think about productivity growth, it comes from three pieces, really. It comes from investment, okay? It comes from human capital, and then it comes from what's called multi-factor productivity growth, for which the purposes of this we can call innovation. But partly, in our analysis, the innovation and the investment are tied together. That the industries which have been investing highly are the innovative ones, suggesting that these are not two separate factors, but really one for the purposes of our analysis. And that the way to fix this is partly to attack the investment and partly to attack the narrowness of innovation and make it more inclusive. And so, you know, one of our mantras is not that innovation destroys jobs, but innovation creates jobs. And we need more of it across a wider range of the economy. And so that's a complicated thing, but it kind of informs a lot of our work.
My question is for Robert and Jennifer. I hear all the time from businesses. I hear all the time from businesses. You know, regulatory uncertainty is causing us to like invest less. But whenever I press them on it, they seldom sort of come up with specifics. It's always kind of this vague sort of background sort of sense. So I was wondering if either of you can actually specify a federal rulemaking that caused you to delay or actually suspend or scrap an investment project, and what was it? And I don't mean like a local interpretation, like an environmental impact study of a specific project. I mean a federal rulemaking. Did net neutrality cause you to actually not do something that you otherwise would have done? My second question, both of you as well, we've heard a lot about the impact of activist investors on how corporates deploy cash. A lot of pressure to give it back to shareholders through dividends or share buybacks, to cut research budgets, to cut CapEx budgets. Do either of you sort of sense that when you're on investor calls? Is that a factor?
So I'll talk about net neutrality, since you mentioned net neutrality.
Not that you needed encouragement.
So glad we found a question that I could talk to you about. What we had, Michael said it too, it's not no regulation, it's smart regulation. What we had in our space, for the last 10 years is we've had a debate about making sure that the internet remained open and making sure that we didn't have the ISPs being gatekeepers of where people could go and what they could do on the internet. And for the last 10 years, we've had rules or principles in place that the industry collectively adhered to. We had a couple of court proceedings based on some rules that the FCC enacted. We weren't real happy that those cases went to court. But what we had was an environment which said, hey, we're going to be all about internet openness at the FCC, and we're going to have a structure in place, and we're going to hold you to the structure that's going to require you to maintain internet openness without getting into Title II rate regulation. And the thing that happened is what's happened is we've taken those rules, and now we've applied Title II, and we've applied common carriage to them. Now, the mantra out of the FCC today has been, yeah? I think it's put a cloud on the investment in terms. That's what I'm saying. That's what I always hear. I always hear about clouds. I never actually hear about specific projects being suspended. Well, you can look at what our CapEx budget went to this year, and our CapEx budget went down $3 billion this year. And when Randall talks about that to investors, and he goes to the street and he talks about it, he points to the regulatory framework change, and he says, that's going to create uncertainty as to whether or not we're going to be able to get to return on the investment. I don't think he's pointed to it and said, this is the only reason that's a result of that. I think he points to a number of different reasons and a number of different uncertainties out there that that ends up where we end up. But I don't think that Randall has ever gone out and said, the net neutrality rule had this, and this is the effect, and this is the impact, and this is the only thing that caused this thing to happen. But I think what we're talking about and what I've been talking about generally today is we've been a good news story in the area of investment. You're starting to see clouds on the horizon, and now you're starting to see the CapEx numbers go down. And I think if we end up where we're all afraid that we're going to end up, which is in a rate-regulated world, that we're going to start talking about regulating wholesale rates again, we're going to talk about regulating retail rates again, we're going to talk about you can't go and you can't create services for this part of the market. All of that's going to impact the return on investment, and I think what you're going to see as a result of that is you're going to see CapEx numbers go down across the board.
Well, I'm interested in the answer to Greg's second question. We have run out of time, and so I just want to say thank you to everyone, and thanks so much to our panel. It was really, really a great conversation. Thank you all.
Oh, she's with me. You should just stand in the back or sit in the back.
Okay. We've got a whole person. So how's it going? Any fires putting out today?
I mean, they're managing to fund the government through December 11th. We're really proud of them.
Yes. We were talking about that as a new factor of certainty. That wouldn't have. Well, we won't have political dysfunction's been postponed for 2 months, and maybe that'll have a good impact on investment. One of the issues that's come up is whether the business investment slump is cyclical or structural. Maybe if you have a chance to get to that, or maybe it'll come up in a question, or maybe it's too wonky for this panel. But there was some debate about that earlier.
Yeah, no, I mean, actually getting into that.
Okay, good.
It's been updated, so just let me fix that.
Okay. Okay. Thank you. First, thank you very much to Jim Tankersley for leading such a stimulating conversation about a business investment. And now it's my pleasure to welcome back to a PPI forum Jason Furman, our friend, and of course known to you as the chairman of the CEA at the White House. Jason, I should say we've had a great conversation here with economists and business representatives on the productivity slump and its likely causes. A lot of the conversations centered on government policy, not be shocked to hear, regulatory policy, high business taxes. But there's also a considerable emphasis on Wall Street and the signals coming from Wall Street, which dampen and arguably penalize business investment that might not
have an immediate beneficial impact on stock valuations. But it'll be interesting to get your views on that. So we're going to move as seamlessly as possible to Jason's presentation. Again, very grateful for you making the time to come over today, Jason, to be with us. Jason took over as chairman of CEA in 2013. And he's a member of the president's cabinet in that capacity. He's served the president since the beginning of this administration in a variety of roles of the National Economic Council and as an assistant to the president. He also worked in the CEA and the NEC during the Clinton administration, so I think we probably first met. And between his White House stints, Jason ran the Hamilton Project over at the Brookings Institution, which for my money was one of the most creative founts of ideas in that interregnum in town. And I say that as somebody who runs a different think tank, but Hamilton did great work, which I followed and consumed avidly, as I do all things that come from Jason. And Jason holds a PhD from Harvard University. He, I should say, is a sort of a celebrity footnote, apparently room with Matt Damon in his first year there, and I believe was the inspiration for Good Will Hunting. Maybe he'll talk about that. But Jason is sort of known as you know, a brainiac in this administration. The Washington Post once called him the wonkiest wonk in the White House. And he's really turned, that's a great thing from my perspective, and he, you know, he's really turned the CEA into this marvelous think tank that churns out analysis across an amazing breadth of topical subjects, from, you know, fiscal policy to the anti-poverty policy and its real returns over the years, tax policy and health economics, Social Security, domestic and international macroeconomics. And Jason himself has gone around the think tanks in town offering what I call a kind of a rolling seminar, where he has given presentations on these and other topics, and really has become a great explicator of economic complexities to lay audiences and non-economists like me. For example, he has read and dissected the arguments of Thomas Piketty, so you don't have to, and has offered some wonderful insights on them. And as I say, it's been a real kind of a public service to have the White House CEA chair out and about in the community talking about the topical issues, and that's what he's going to do today with his presentation on the link between the reduced business investment and the slowdown in productivity growth, which is at the root of many of our economic discontents. So with that, Jason, thank you so much for taking the time, and over to you.
Okay, thank you. Will, thank you so much for that introduction. Thank you for everything that PPI has done for more than a quarter century in helping to drive the economic policy dialogue, to bring new ideas forward, to expand growth, and help ensure that that growth is sustained. I would have been happy coming to PPI to talk about any topic, but I was particularly excited to be talking about investment. One, because investment is really important in the economy. It's important for our productivity growth. It's important, thus in turn, for wages, the future fiscal outlook, and a range of questions in economic policy. The second reason is that investment has been particularly notable in this recovery because some aspects of the economy have consistently outpaced expectations. The same cannot be said of investment, and that, at least superficially, presents somewhat of a puzzle. And then third, because PPI itself has done such great work on investment. You publish the Investment Heroes report every year that highlights facts like the large increase in investment by ISPs that makes the United States a leader in 4G, the large increase in investment in the oil and gas industry that has increased oil production by an amount equal to what Iraq produces each year and made us one of the leading exporters of LNG, the big increases in investment in clean energy that have tripled our wind power and increased our solar 20-fold, and the increases in auto investment that have put the United States auto industry back on track. But you don't just document that. Under the leadership of Michael Mandel, you consistently have a very thoughtful and interesting take on investment. And in that context, wanted to offer mine today. One basic idea that you hear about is, just to preview the main point of my remarks, is that there's been a big increase in cash flows. There are substantial accumulated earnings in the United States and abroad. Why would businesses not invest this money unless it's uncertainty or regulations or some flaw in our tax code or some accumulated consequence of the Great Recession or something like that? What I'm going to argue is that a lot of the evidence is not consistent with that set of stories. It's not consistent because you see the investment slow down across a wide range of countries, because you actually see an improvement in other areas in the economy, like the job market, and because actually a number of these indicators have actually gotten better in terms of uncertainty and business optimism over the course of the economy. Instead, it's just an old-fashioned economic theory that goes back more than 65 years to Paul Samuelson, which is called the accelerator model, that basically says businesses invest based on aggregate demand, and you need to improve aggregate demand to improve investment. I'm also going to try to talk to you about a few different puzzles in investment that I think we don't fully understand, and then last, quickly go through the administration's agenda in this regard. The big puzzle, though, is something you can see in this chart. The red line shows non-farm employment, the growth over the last 4 quarters, and that's been strong and growing stronger. And the blue line, which is real business investment over the last 4 quarters, historically that has tracked non-farm employment, and the two indicators have given you a similar read about the economy. In the last several years, they've diverged, and it's that divergence that I guess is the topic of today's seminar. As I said, that divergence is one you see across a range of advanced economies, and in case you can't read all of these, the first one is real business fixed investment. It shows the trend that we were on before the recession and that we're several percentage points below that trend. And you drill down, you see it in both equipment, especially, and to some degree in structures on the business side. And then you see an even larger shortfall in residential investment. This is something you see in pretty much all of the advanced economies, looking at them individually, as you see in the slide. And this is the percentage deviation here from the forecasts that the IMF made in the spring of 2007 relative to where investment actually was in the year 2014. The blue part is the main topic of my discussion today, which is business investment. And in most economies, that represents the largest share of the shortfall. The red is residential investment. That's an important part of the overall economic story, but outside the scope of what I'm discussing today, and not as big in terms of its macroeconomic effect as the business side. And then finally, depending on what country you're looking at, there's potentially a gray bar, which shows a shortfall of public investment from what was expected, which is a smaller part of the story than either of the two above. Looking now specifically at some of the facts for the United States, the first set of facts, it breaks down business investment into its 3 components. The red is equipment, and that's the largest source of business investment, and that is the investment that we've seen the growth rate slowing for over the course of the expansion. The gray bar is structures, and then that blue bar is intellectual property products. That's nearly half R&D, nearly half software, and the remainder is film royalties and the like. And you actually see that accelerating over the course of this economic expansion, which is consistent with its historical pattern. It's growing at about 3 times faster than the pace of GDP growth, so it's now risen to a record level as a share of GDP. And I think that's an important bright spot in the overall story if you're asking questions about the future of productivity growth. This both represents a bet on the future of productivity growth as well as an input into that growth. In the context of the United States, it's also useful to break out investment in everything except drilling and investment in drilling. And over the last 2 or 3 years, the fall in the price of oil, which has led to a large reduction in investment in this sector, more than fully explains the slower growth of business investment that we've seen. I do want to note that overall the impact of lower oil prices is a significant positive for the U.S. economy, as it puts $700 in the pockets of a typical household, enabling them to spend more. But purely on the investment side, through its effect on oil, it's a negative. There's also some evidence that that negative has stabilized, with the number of rigs in operation having stabilized since May. So this is important to keep in mind for the last year or two. It doesn't, though, explain that longer historical pattern that I was showing you. To explain that longer historical pattern, as I said, the model that economists are taught in their textbooks, the first one we turn to, is a so-called accelerator model. And in the simplest version, a representative firm that has constant returns to scale chooses its level of capital based on its expected rate of return, or something like the growth in the economy. Investment is the change in the capital stock, so that means investment is a function of the change in the growth rate, or how much the level of output is accelerating. We've done, to show you one picture, which doesn't get the derivatives exactly right. There's a slightly more complicated picture that does, and the lines also track each other. You basically see GDP growth in green, which represents demand, and investment growth in blue are roughly tracking each other. We've done more extensive internal work that shows that an accelerator model is pretty close to fitting. And the IMF and the OECD have both published research, with the IMF saying that across most of the major advanced economies, investment today is almost exactly where you would predict given aggregate demand. And their research attempts to solve some of the correlation versus causation problems by using changes in the government budget as, in effect, a random experiment or an instrument for their results. The exception is the IMF finds, is in a number of the peripheral European economies where investment is lower than what would be explained by an accelerator model. So it seems like those are the places where confidence, regulation, all these other set of factors would make the most sense as being needed to fully explain what we've seen. When you look at those variables in terms of confidence, the next slide shows business confidence. The blue and the red are both numbers for small businesses. They've both generally trended up over the course of the business cycle. Green is CEOs. It's for the BRT, major companies. It's been roughly flat at where it was before the crisis. But both of those are inconsistent with that pattern of investment we've seen in the last 6 years, as is different measures of uncertainty, of which the VIX Volatility Index and the Economic Policy Uncertainty Index from Bloom and Davis are two examples where, with the exception of the recent uptick around the global turmoil, in general, you've seen improvements in these measures of uncertainty. What that suggests to me is if you start with that textbook model, the accelerator, seems to basically predict what we've seen. Insofar as you bring in other factors like confidence, uncertainty, they would tell you, if anything, you'd be investing more than that model would have said. So it might be that the improvements in these dimensions have been offset by the overhang in capital in the aftermath of the Great Recession, some of the credit crunches we've seen. So the difficulties you always have coming out of a financial crisis, the improving optimism, roughly cancel out, and you're left with the standard model working reasonably well. So I think in that sense, what we've seen in the last couple of years isn't a very big mystery. A lot of it is a cyclical effect, and it's one that we would expect to some degree to resolve itself going forward. There are three questions about investment, though, that continue to puzzle a lot of people, and I would not name myself as an exception to that general puzzlement. And I wanted to put them down on the table, offer some speculations, but suggest that the only thing I'm sure about in the case of all three is that additional research, discussion, and thought is warranted. The first is the question that Larry Summers has raised, which is the observation that Snapchat and WhatsApp both have larger market valuations than Sony, even though Sony has a very large capital base, intellectual and otherwise, that you don't see in these corporations. So maybe, given modern technology, we just don't need to invest as much as we used to. It's ideas that are driving it, not this type of investment. I should say that if that story is true, it'd actually be a perfectly happy story, that we can get economic growth, that we can get productivity growth without having to supply a lot in the way of inputs. It's an idea that has implications for equilibrium rates of interest and other aspects of economic management, but to a first approximation, it's actually a good story. I'm not positive, however, whether or not it's true. If you think about Snapchat and WhatsApp, they don't require a lot of capital, but the only way we all can get them is through really expensive investments in fixed wireline networks or wireless networks. And so as investment in one part of the economy has declined, a set of complementary investment has increased. And you look at overall gross domestic investment as a share of the economy, that blue line at the top, and at least up until the recession itself, it was at its historical level as a share of GDP. Now, since then it's fallen. It could be that the structural changes have all occurred since the year 2007, but we did see the first two rounds of major internet innovation happen before the beginning of 2007. Could be that our 2007 number was an unsustainable bubble and the true level was below that. It could be that the demand curve shifted, but at the same time the supply of savings went up, so the price went down in terms of a lower interest rate without the quantity. But whatever it is, it at least makes me a little bit less convinced that you should tell a broad structural change story around a couple years of data when you saw a pretty consistent flat trend before that. A flat trend with one important caveat to it, which is that the blue line is gross investment. The composition of investment has shifted towards shorter term, think computers rather than machines in a factory. Those depreciate more quickly, so more of that blue investment that you're seeing is replacing the capital stock rather than adding to the capital stock, and net investment was trending lower as a share of the economy even before the recession. The second puzzle is why we've seen an increase in the rate of return on capital at the same time that we've seen an increase in payouts to shareholders through share buybacks and dividends. I think part of this is the normal cyclical stuff I was talking about in the accelerator model. Part of the explanation is that for several decades now, the composition of our business sector has been increasingly tilted towards older firms. The rate of new business formation has been falling since the 1980s. And older, more mature firms tend to have less new investment prospects and less expansion prospects, and as a result, appropriately would return more of their revenue to their shareholders. So that longer-term structural shift may have something to do with what we're seeing there. I think another interesting idea that helps square the rate of return with that trend is the fact that we've seen a lot more skewness in the return to capital. And you look, the distribution, the means of the rate of return on equity across the S&P 500 haven't changed a lot since 1991 and 2014, but there's a lot more firms now with 25, 30, 40% rates of return. The persistence of those rates of return have also gone up, and that could be indicative of an economy which has a greater degree of rents, where businesses are able to get lucky on something, be the first to get it, and have an advantage that persists year after year without this type of competition that drives investment that you might see in other sectors. The last puzzle that is important to talk about is the degree to which everything I've said so far is correct, or whether it's all wrong because the data that I've shown you in every one of the pictures is wrong, because the price indices we use to measure changes in investment are wrong. That is an important question to be asking ourselves, insofar as a new computer or a new robot is a lot more effective than an old computer or an old robot. The price of it went up less than is recorded in the official statistics, or down even more than is recorded in the official statistics, insofar as BLS and BEA don't track that. That would mean nominal investment growth was the same, but the portion of it that's real investment growth would have been faster because we're putting better and better equipment in place, and price growth would have been lower. There's a set of research, including by Oliner, Sickle, and others, and semiconductors and other areas, that has looked to document this. One way of looking at it is comparing investment growth from 1990 to 1999 and 2010 to 2015. Nominal investment growth in those two periods was about the same, the height of these bars, but the apportionment of it into real investment and investment prices was different. So real investment growth slowed because price growth was higher. I think this is a puzzle that is worth further thought and discussion. My own sense is that it is unlikely that any such measurement issues would be large enough to overturn any of the broad conclusions that I've just been discussing. We don't know the degree to which there are examples that go in the other direction from some of the ones we've seen, how large it all adds up to. So I tend to think everything we're worried about, we should be worried about, but on top of all those worries would suggest we worry about whether we should be worrying about it in terms of, are we measuring the economy correctly? All of this brings me to why this is important, and I'll skip over that relatively quickly. It's something I had the chance to talk about at greater length at Peterson over the summer, and I'd suggest you look for that on our website if you're interested. But the important lesson here is if you look at the slowdown in productivity, which people have talked about, the biggest factor in it is capital intensity, which had been adding to productivity for decades, is now subtracting from it. So this investment question we've been talking about is of first order importance to understanding why productivity growth has slowed. And then the outlook for capital investment is really important for understanding what the outlook for productivity is. I tend to think that the historical evidence is that if anything, you see some mean reversion, so periods of slower growth are followed by faster growth, that we had a lot of capital overhang in the wake of the Great Recession, and so there's some reason to expect you're going to see a pickup of capital growth in the future and an increase in productivity growth as a result. But I think that's, whether or not you see that is going to be a particularly important question. Finally, wanted to just tick through some of the elements of our agenda. Insofar as you think aggregate demand is critical to investment, because aggregate demand gives you customers who can spend more and gives you a reason to invest, then macroeconomic policy actually matters a lot for business investment. One of the most important macroeconomic policies that we're responsible for right now, or partially responsible for, is the future of the budget. And the Congressional Budget Office has said that if the sequester goes into effect, that would subtract 0.4 percentage point from GDP growth in 2016, which would have a knock-on effect on investment. I'd note that 0.4% of GDP estimate from CBO is actually twice what Goldman Sachs estimated the economic costs of the slowdown and turmoil in the Chinese economy would have on the US economy. So if you think it's worth discussing, whether events in China are affecting the US economy, then it's definitely worth discussing whether the sequester will affect the US economy. The sequester doesn't just matter through aggregate demand, it also matters through supply. And if, for example, a full year CR went into effect over the course of this year, the result would be, relative to the president's budget, 1,300 fewer grants in NIH, 1,000 fewer National Science Foundation grants, and while R&D at the business level, which is mostly D, has gone up as a share of GDP, the R, the pure research, has gone down as a share of GDP, and the sequester would make it impossible to solve that. We don't just need technological investments, we need investments in our infrastructure that complements business investment on the demand side as well as on the supply side. Infrastructure investment isn't just a matter of more federal dollars. It's things like the Enhanced Federal Infrastructure Permitting Dashboard and guidance to agencies about permitting and environmental review, as well as leveraging private capital through the Build America initiative. Business tax reform can play an important role, lowering the rate, broadening the base, and making sure that capital is being allocated to the highest returning projects rather than to the greatest tax advantages. In that regard, it's important economically that we not extend or make permanent bonus depreciation, which played an important role as a counter-cyclical measure during the economic crisis. But were it to be made permanent, it would add substantially to the deficit with little benefit for the broader economy. The tax code should also aim to encourage and support innovation. And the most cost-effective way to do that is through the president's proposal to expand, reform, and make permanent the R&D tax credit, an activity that would subsidize innovative investments made here in the United States on a going-forward basis. It's also an idea that provides a much higher bang for the buck than an innovation or patent box, which, unlike an R&D credit, would provide a windfall for decisions that have already been made, highly profitable investments that would have been pursued without additional tax incentive, as well as just pure luck. Encouraging innovation goes beyond fiscal policy. It includes things like expanding the amount of spectrum available for mobile broadband, setting expectations for automakers and power companies years in advance in terms of what they're going to need to do to comply with clean air rules, and a range of other things. Manufacturing is particularly important given the amount of R&D and exports, and has been a big focus in terms of the manufacturing institutes and other policies. As I said, that several decade-long trend in small business formation and new businesses is another concern and another focus of a lot of our efforts on small business. And then finally, I would highlight that investment is not just a domestic concern, it's also an international concern. So expanding markets overseas, for example, through TPP, doesn't just expand investment in the export sector. By creating more competition, it can actually lead to more innovation and learning here in the United States. Similarly, initiatives like Select USA can attract more investment here in the United States. Now, ultimately, our goal is a faster growing economy. That'll help solve almost every other economic problem that we have. An important part of that is both the quantity and quality of investment, which in turn depends on both private investment and public investment. Understanding the causes of what we've seen is very important. Encouraging and supporting increased investment is important, and a number of these range of policy ideas I've talked about are particularly important. So, thank you.
Thank you very much, Jason, for that presentation. Do you have time to take
I have time, yeah.
Over to you. Folks, please wait for the
As long as they're not from Greg, who always asks things that are too hard. Need more time to think.
No questions. Inconceivable. Somebody must have one.
Yeah.
Ken?
And then we'll get Jim right
Ken
afterwards.
Jarbo. Yeah, back here, and then we'll go to Jim.
Who's also a little intimidating, but I'll.
One of the things that we talked about earlier with round of investment, one of the things hearing from Michael on the panel that worries me is our definitions of investment. Specifically, are we capturing the intangible investments that we're making, such as organizational changes, beyond R&D, things that don't necessarily go into capital deepening, but go into total factor productivity area? What can we do to get a better sense of what's really happening in that area?
Right. So we do a much better job on intellectual property than we did 5 years ago, which is to say it's included in GDP now, and it didn't used to be 5 years ago. That being said, you just identified a few areas of intellectual property that I don't think are captured in the statistics. I don't know that they would fully solve our quandary. If anything, they would suggest that we've had more capital investment. That we've had more, I don't think they'd change total productivity, because total productivity is the end result of everything that we're doing. So the amount of cars you produce or the amount of iPhones that you produce would not be mismeasured because of what you said. What you just described might change how we allocate that productivity between total factor productivity and capital investment. And so I'm not sure that would resolve, what we're most worried about.
Doesn't that get into the policy areas of where you need to, in fact, put your focus at the time, as you talked about the accelerated depreciation not being necessarily a good idea, bonus accelerated depreciation not being a good idea on the upswing from the recession. Maybe we need to rethink where we're putting some of our focus on the policy areas, if it's more total factor productivity is the issue and not capital deepening.
Yeah, I think that's an interesting point. So I think we had Jim.
Okay, so we've been talking a lot. We talked about it on the panel. We've been talking. You talked a bit about uncertainty, and uncertainty can cover any manner of sins. But the one way that it really has been used recently and in the recent past is to talk about the uncertainty of whether or not the government's actually going to be open tomorrow, or we are going to actually be able to borrow as a country anymore. Given that we are right now on what appears to be the eve of at least a short-term aversion of a shutdown, can you talk at all? Is there any evidence that the uncertainty over government shutdowns and debt limit problems has impacted investment at all during the recovery?
Right. So let me be clear. Uncertainty is harmful to the economy. Uncertainty is completely unnecessary. There's a lot of things where there's a trade-off. Maybe you want more of this, and it helps you in one way, hurts you in another. Uncertainty just hurts you. It certainly gives businesses a reason to wait and see rather than making a fixed capital commitment today. And the uncertainty we've seen over the debt limit and the fiscal cliff, the sequester, the whole range of things we've seen, I think have hurt, have been unnecessary and have unnecessarily hurt our economy. Macro advisors did an estimate using the economic policy uncertainty index I'm showing here, where they put the number in terms of the fiscal uncertainty at 900,000 jobs were lost a couple of years ago as a result of it, and I don't find that, really implausible. You see that uncertainty in the blue line there, where it was elevated during the worst of those years of Congress, not doing its job in terms of the debt limit, spending bills, et cetera. I think, though, it doesn't fully resolve the story, because you see since those years that uncertainty has gone down. So it is something we want to guard against. It's something we don't want to reproduce the conditions that Congress put us in 2011, 2012, and 2013, 3 years in a row. But, so in that sense, I think it matters, but I don't think it's the biggest, the number one fully explaining the trajectory of the economy we've seen, because you've seen the trajectory persist past then.
I think Bill Galston.
Yeah.
2 questions. First of all, the instantly famous OECD report on the future of productivity places a lot of stress on what they call innovation diffusion. That is, and they note that the leaders, whether global or national, are doing better than ever, but the connection between the best and the rest seems to have broken down quite considerably. So do you agree? And if so, what's the explanation? What can be done about that? Second question, is all investment created equal? I've been reading some very good papers recently to the effect that in the private sector, investment has shifted away from R and towards D, and that may be good for short-term results, but it's crummy for long-term innovation and growth. And that decrease in the private sector has not been compensated for by an increase in the public sector. If anything, just the reverse. So how important is our failure to keep up adequate levels of research, basic research for these long-term problems that we're talking about?
I think those are both really important questions. I chair the OECD's Economic Policy Committee, and very much have encouraged that work, and we're trying to get the OECD to do more to both diffuse its work as well as get more people into it. I'm not, it's affected my thinking. It's been, I think, a new contribution to the analysis. I don't think the tires have fully been kicked on it at a technical level. I mean, there's some points we could talk about later in terms of, there's a little bit of, if you define firms ex post as successful, they're going to have been more successful over the period you're looking at. There's an element of that creeps into their work, not quite as bad as what I just said. Their numbers are a little bit, I think 2012 is the last number they have, and they're bouncing around a certain amount. So, it's not their fault that we don't have 2013 and 14, but I'd feel a lot better about proclaiming a trend after we see those. But I think, pending all of that, I think it is worth thinking hard. And it does help reconcile that puzzle of all the excitement you read about in the newspapers, then what you see in the aggregate data, and so some firms are exciting and it's not diffusing to others. I think it gets to things like the business formation I was talking about. On your second question, I very much think all investment is not created equal, and I think if you look at something like our business tax reform plan, for example, I think it would increase investment, the quantity of investment. I think the real goal is increasing the quality of investment. And so partly you do that by having similar tax rates across different types of activities. So you're not investing more in things with lower rates and less in things with higher rates. You're investing, as I said, you're allocating your capital correctly, not misallocating it. And then also, I think research has a substantial positive externality. So I'd make an exception to that statement for research, and that's why I think the R&D credit is particularly important. And I think in general, really focusing not on, how do we get the cost of capital as low as possible to raise investment as much as possible, but how can we have a more neutral tax system and one that encourages, except insofar as it encourages innovation, so that we can improve the quality of capital, is a somewhat different paradigm for business tax investment and has business tax reform, and one that has the advantage of, you don't lose money by achieving my goals in the way that you often do when achieving that first set. So I think this woman had a question and then probably would have to end it there.
Hi, I'm Sharon Bovat, Voice of a Moderate. I have a quick question because you mentioned the word uncertainty, and I heard that a lot when Obamacare was going through the courts. People in small businesses would say, we're not going to hire until we have certainty. And it seems like we're in perpetual uncertainty. There's always an uncertainty. There's a presidential election. There's something in the future. Is there a way to make people feel comfortable in investing today? What is going on in our government to say, it just seems like for 6 years there's always been some sort of uncertainty. And I just keep hearing that word over and over again. So to get America on track, I think maybe there's an infrastructure stimulus, but when we look at the numbers about the investment coming in, I think you understand what my question is.
Yeah.
How do we get people
Yep.
on track with believing that things are going to be certain?
Right. So this blue index is basically actually a measure of how much you hear the word uncertainty. And you can see it's gone up and down because of a range of things. I think part of it is getting, our having a more predictable fiscal system. So the Ryan Murray agreement is one that gave us for more than a year and a half agreements on spending levels. There's then important debates on how to spend that money, but none of those rose to the level of existential or massive uncertainty for the economy. We proposed something exactly like that along the same template in our budget at the beginning of this year. And you've now seen Congress spend a month or two debating Planned Parenthood, and that's not a debate that has helped our economy or reduced uncertainty. So, I think that's part of the answer. But again, I don't want to overstate uncertainty. You just talked about small businesses in the ACA. Well, all the jobs created have been full-time, not part-time, and job growth has generally outpaced what anyone had expected. So, businesses aren't just paralyzed by uncertainty, not moving forward. They are moving forward and hiring people. They are not investing at a commensurate rate, and it's some of that puzzle that I was trying to discuss today.
Thank you very much, Jason.
Okay, thank you.
One thing I'm very certain of is that our country's lucky to have someone like Jason Furman, who is not only studying these issues with great trenchancy, but willing to come out and engage the community on them. So Jason, thank you so much for taking the time to be with us today. In the future, I hope we'll have a chance to talk a little more about regulation on your tick list, but that'll be a subject for a future conversation. But thanks again, and thank you all for coming out today and sticking with us throughout this discussion.